speaking to the mic?
Hi, my name is Mike Menendez. I'm the president of the Southern Impact Investment Alliance. We're a 501c3 nonprofit that is dedicated to building an impact investing ecosystem in the state of Texas. We have a lot of different projects that we're involved with, but primarily it's focused on research and education. And we do a lot in terms of facilitating introductions and stuff like that with entrepreneurs and investors as well. So.
Good evening, Heath Butler. I'm a network partner with Mercury Fund and co-founder of the Urban Capital Network, recent angel network group formed to aggregate investors who are committed to closing the innovation, wealth, and jobs gaps in urban communities around the country.
My name is Rian Davis. I work with Let's Launch. We are a FINRA and SEC equity crowdfunding platform. So we help small businesses and startups that are early stage raise funding by allowing their friends, family, community, customers to invest in their business. And so they actually own a piece of the business and they grow with the business.
Hi, I'm Lily Liu. I'm with Mercury Fund. We are an early stage venture capital group based here in Houston. We focus primarily on B2B and B2B2C software, data science, cloud platforms, and AI. So we invest in what we call high growth startups. We provide equity in exchange for ownership of the business. And we are industry agnostic, so we invest oil and gas, health sciences, life sciences, retail, CPG, manufacturing. Typically when companies come to us, they are about $1 million in revenue and need capital in order to be able to scale.
Hi everyone, my name is Stephanie Campbell. I'm the managing director of the Houston Angel Network, the largest and oldest angel network in Houston, one of the most active angel networks in the United States. Our members invest somewhere between $6 and $10 million annually in early stage startups. The deal sizes are typically between $250,000 and maybe up to $2 million raises, so seed, very early Series A. We also are industry agnostic. We do a lot of life sciences, oil and gas, tech, consumer, aerospace. We don't do real estate, we don't do restaurants, we don't do franchises. And then I'm also the co-founder of the Artemis Fund, which is the first female-focused VC fund in Houston. We invest in seed, Series A, and opportunistically some Series B companies led by women in the tech space.
I'm Abe Chu with NextSeed. We're an online investment platform focused primarily on Main Street businesses. We do invest, or our platform does work with restaurants and fitness studios and retail. We're also expanding into consumer packaged goods, real estate, things like that. The platform has facilitated about $13, $14 million in financing to over 50 businesses so far, and growing. And we launched our broker-dealer license earlier this year. So the types of capital we're working with and reviewing and diligencing for fundraising on the site is expanding. So we're looking at deals largely ranging between $200,000 to $5 million, and looking at different stages along the way. Yeah.
Thank you. So can you talk about the type of entrepreneurs that you are looking for? So a few of you mentioned that you're looking for seed stage or early stage startups, for instance. What kind of entrepreneurs would be ideal, for the services that you're providing? And then how would they best engage with you? What do they have to prepare for?
Sure. So on NextSeed, we're looking for entrepreneurs that have a lot of domain expertise. They may or may not have run the same or very similar business in the past, but have a deep understanding of their industry and how to operate. One of the key things that we convey to people is that, and you have to think about it from a storytelling perspective, right? We're not making a direct investment, we're helping the entrepreneur tell the story about how they're going to be successful and why people should invest in them, why their community should invest in them. And a lot of it is about that history and trust and track record. Part of our process is that a business owner would submit an application to us, including their business plan, financials, pro formas. Our investment banking team then reviews and diligences the deal, comes back to them and reviews terms, and from there, if we agree to terms, we launch the campaign on the site, and then help with fundraising. We do a lot of marketing, press, outreach, etc. So at that point, we're really deeply engaged with the team.
So similar to Abe, we're also looking for founders that have expertise. Also, I think both at Han and Artemis, something that I think founders miss out on is a deep understanding of their customer. Really knowing how their customer makes purchasing decisions, who is the person making the purchasing decision, understands how to get in front of that customer in terms of content. It's not just Facebook and Instagram ads. So a deep understanding of their customer, their spending habits, and how long it takes to get to that customer and make a sale is really important. So just in addition to experience, there's that. That's mostly at Han and Artemis. I would say Artemis, we're looking for female founders, obviously. That's a hard requirement. And not just a token woman who happens to be doing sales and marketing, but someone who has significant equity shares, who is driving the business. That's really important to us. For Han, the first step is you have to apply online. It's right at the top, it says apply for funding. Submit an application and we review those monthly. For Artemis, we don't have that process right now. It's really us stretching our network and them coming to us directly. But feel free to email me. It's Stephanie@theartemisfund.com. It's dangerous, but email me.
At Mercury Fund, our mission is to fund entrepreneurs and technologies that make the industries in the middle of the country more competitive and efficient. And so for us, we want our founders to really create solutions that solve real world problems within manufacturing, within oil and gas, within retail. And as part of that, when companies come to us, they should have or are close to establishing product market fit, which means that they've got a baseline product that they've been able to sell to multiple customers, and not just friends and family, not just that one token customer that they got on which this idea was based off of, but multiple customers that truly want the solution that they have developed because they are really facing the problem. So typically, entrepreneurs can reach out through, we have an info@mercuryfund.com. Feel free to submit your business plan, and come meet us at events and email us.
So I wouldn't say that we're too dissimilar, apart from the fact that we focus on early stage startups and small businesses. So we tend to see businesses that are pre-seed in that friends and family round. They have the friends and family that want to put into their business. They have the community that wants to invest in their business, and they're looking for smaller amounts of capital. So we tend to see raises of 100 to 200,000 on our platform. And that business may be raising offline as well on the same terms with high wealth individuals, but they realize that they can raise a couple of 100,000 from their network, and they want to supplement their raise by doing that. In terms of ways you can get in touch with us, you can also email me, come speak to me afterwards, grab a business card, or you can go to letslaunch.com and apply online. Very similar process to Nextseed.
Now, because of the angel network that we're a part of, we are looking to attract investors that have not traditionally invested in this asset class. We typically are looking for what we kind of call de-risked type opportunities. So it's going to look like what Lily talked about and what Stephanie talked about, where the businesses are a little bit further along, have revenue, and venture investors are looking to invest in them, and we co-invest with those venture investors.
So for us, we have a little bit of a different relationship, just being a nonprofit. We tend to be more of a general resource. So if you're an entrepreneur and you have questions about funding, or you fit a particular profile, we refer you to a group that we think would be a good fit for you. We also have developed a data visualization called the Texas Impact Ecosystem Map, and basically we mapped social entrepreneurs and different impact-oriented organizations across the state of Texas. You can go there and say, for example, if you're looking for an accelerator in Austin that's focused on energy efficiency, you can click a couple buttons and find all those people that are doing that type of programming. So I encourage you, if you have a social, if you're a social entrepreneur, you have a socially positive or environmentally positive business model, go to the map, submit, so we have your information. And likewise, if any of the investors in the room that want to be listed on the map, feel free to go ahead and we'll make sure that you get on.
You just don't see that kind of thing coming, right? So, so those kinds of opportunities are really exciting. That the Prison Entrepreneurship Program has come a long way, and they're getting into really interesting spaces and places that people can turn their life around with. More closer to home, the things I'm working on is, as trends continue and it's gotten cheaper to launch a startup, that means that it becomes accessible to a lot more people, and also the investment side becomes accessible to a lot more people. So what I'm really passionate about is that more and more you have an opportunity for investors who look like me, who look like different folks on the panel and in the audience, to get access to really good opportunities. So what we're working on is aggregating some of those people, and I don't want to just focus it in on minority participation, but by far and large, that particular group has not had access, but the incomes have increased over the years. So professionals who can qualify as accredited investors and want access to this particular asset class, and helping them get access to it and doing it in a de-risked way. When you think about the chicken and the egg of what does it take to invest in urban communities that have not had the right levels of investment, I believe that if we can find investors who look like those people to make money in this space, they'll turn around and reinvest in their community, and we're creating a model to kind of enable that.
So I'm really excited about the stage before what he just talked about, which is what I consider to be the next generation of investors. So these are essentially the young professionals that aren't yet accredited, that may be accredited in 5 to 10 years or may not be accredited, but actually want to go out and learn about investing, but don't know where, don't know how. And for me, it's about educating those people as to how they can invest in businesses within their community and actually help them grow and do it in a safe and affordable manner before they get to the point where they're accredited and they're being asked to put in a lot more money and they really don't understand all of the terms that they're investing in. So I'm really excited about the stage before that, and we work with the Cannon, another co-working site in Houston, and we're partnered with them specifically to help open up their venture network to non-accredited investors to teach them how to invest in a safe and less financially risky environment. So that's what I would say I'm excited about. And the other thing to mention on that is that the education curve is pretty high, because crowdfunding and equity crowdfunding only came out in 2016. The US was very behind the curve. This is something Europe doesn't have accredited and non-accredited investors. Anyone can invest. So this is a very US thing. And crowdfunding was late on that. So I'm really excited about bringing everybody up that educational curve and then opening up a huge amount of capital to small businesses and startups and communities.
So a little over, actually probably almost 2 years ago, I attended a conference out in San Francisco. It was called the All Raise Conference for Women in VC. And it was the first largest gathering of female investors in the country. Over 400 VCs were at the conference. And I remember something that they said so vividly was that empowering women investors, empowering women entrepreneurs is not just a moment, it's a movement. And that really stuck with me, because it shouldn't just be a trend, right? Because trends come and go. There's always going to be something else that is picked up on the wire, something else that's newsworthy for the week or for the month or for the quarter. But I think that this is something that is going to stick. Because women have, really found their voice, especially women entrepreneurs. And I think that you guys are the catalyst for the women investors, because, you are showing us what you can do, all the challenges that you've gone through in order to start your businesses, to bootstrap your businesses, to fundraise your businesses, that we as investors, the very least we can do is be in, try to find ourselves in positions of power to to be check writers so that we can better support you on your journeys.
You stole my thunder there, Lily. We're in this together. But I think to add on top of everything that she just said, I'm also excited that more women are going to be funded because women are creating solutions for a broader population of consumers. And so I believe that women are going to create the world that I want to see, right? Where, for example, there's one deal that I'm looking at, and I always get a little weird telling about this one, but it expands the vaginal canal in advance of birth to prevent tearing during birth. And it's just something that no one talks about, but most women deal with it. And why wasn't it invented 50 years ago? And there's like it's very simple contraption, and it's like femtech is now hot, and I think it's not just gonna be hot for a little while, it's gonna continue as there are more women investors and women founders, there will be solutions for the other half and more, because there's a multiplier effect when women have capital and start companies and make a bigger impact on their communities, which I think is really exciting.
I guess I'm excited about a few different things, but one is, like Rihanna mentioned, this change in technology is actually opening up quite a bit of things and changing the way people think about investing, and it allows not only access for investors, but it naturally just evolves into opening up access for everybody on the entrepreneur side as well. So on Nextseed, we don't purposefully screen for this, but 80% of our 80% of the dollars that flow through the platform go towards women and minority-owned businesses. Like, it just happens because of the way that this democratization to access just naturally changes how people think about things. I mean, we all know the stats around venture funding, around even traditional lending. I think one of the stats we reference quite a bit is $1 in $23 of traditional lending for women-owned businesses. And I mean, by driving technology and scale, we can level the playing field on that. Also, we recently merged with a firm called Collaboration Capital, another investment team that is really impact-driven. And what we're trying to figure out now, and the integration that we're going through, is how do we give people access to those impact strategies, ESG strategies on the public equity side as well, and democratize access to that. Right now, their wealth management practice requires a high level of entrance. So you have to bring in quite a bit of money in order to tap into some of the resources that they've developed. But obviously, again, through technology, how can we open that up to everybody?
So ESG, can you define that, please?
Sure, environmental, social, and governance. So considerations that are trying to match your values to your actual investment portfolio. So one of the examples that Chris Knapp, the CEO of Collaboration Capital, references is that he's got a family member with an opioid addiction, and their parents, would they purposefully invest in something that is connected to that? They wouldn't. But people don't really think about how their investments really relate to what they really care about. And so by helping people craft their portfolio structure at that even macro level, how can we allow people to put dollars where they care more about? And we view it as a complementary offering where Collaboration Capital on the wealth management side and asset management side can help people on the public equity side. And then through diversifying their portfolio through alternative assets, like what we offer on Nextseed, you can really have a complete view of where you're putting your money, where it's going, and make sure it aligns with what you care about.
Thank you. So I'm going to ask one more question and then open it up to the audience to ask questions. My last question is, you mentioned being excited about more diverse investors, starting to put money to work. Do you have any advice? How can people who might not be accredited investors yet, or who might don't know what an accredited investor is, can somebody please define that as well? But what's some advice for people to start putting their own capital to work?
Yeah, so an accredited investor is defined from a regulatory standpoint, someone who owns who earns $200,000 a year in annual income, or with their spouse earns $300,000, or has a net worth exceeding $1 million, not counting their primary residence. And that regulatory hurdle is, it was put in place really back from the original Great Depression, and it was meant to protect people because at that time a lot of people were cheated out of money and investments, and information was not easily accessible. And so some of these changes in regulations are taking place because of the power of the internet, the power of information and access. And so things like regulation crowdfunding were introduced, again, just the past few years, opening things up. And I think when people think about their investment portfolios, it's pretty intimidating for most people, right? People don't like to think about it. You talk to people about one of the things they fear most, and it's about, okay, well, I don't know if I'm doing the right thing with my money. And I think education goes a long way. Again, as Rhian mentioned, one of the things we do in this industry is focus a lot on education, and whether it's speaking at panels or providing educational materials or co-hosting events with other groups. That's really an area that it's really on each of us to get more educated personally, but I think one thing that everyone on this panel is responsible for is also providing that access.
Yeah, so in addition to the SEC rules about accredited investors, there's also rules for funds. So, and as Keith alluded to, I was been a long week. Keith alluded to, it's been tough for minorities and women to invest at such a high, it's a $250,000 minimum to get into my fund, right? And so we have, but the rules are that I can only have 99 investors in my fund if I'm raising more than $10 million. So not a lot of women, if they decide they're going to invest for the first time, have $250,000 they want to commit to the fund. And so it's been hard to find, so we've lowered it, right? We've lowered the minimum because we want women in. And so that means we have to find men or really wealthy people to write us twice as much, right, to make it balance. So we've lowered the minimum because we want them to learn, we want them to get education, we want them to participate and realize that this is something they can do and make money and then continue to invest. But those rules are tough. They make it tough for us as GPs in a fund, general partners in a fund, to raise money from people who haven't traditionally invested and are not really comfortable with that large amount. So what you can do, there's lots of other groups that are not like ours. We're a traditional VC model, and we are very set on just being a typical VC that happens to be run by women, investing in badass companies that just happen to be run by women, and that's our MO. But there's a lot of other groups out there. There's something called Portfolio where you can write a much smaller check into a fund and learn. The marketing costs are higher, but it's more about writing a $10,000 check to learn what investing is about. There's tons of other groups that are starting smaller micro funds that you can get into. Yeah, there's tons of books you can read. There's a book called Venture Deals by Brad Felds. I always promote that. I just try to absorb everything I can about venture capital industry, from blogs, from reading, it's just self-education, right? There's information is out there for you to find.
I would say if you're writing that first check, no matter how large or small it is, make sure it's to a cause that you support and love. Because the thing about venture is most of these deals are going to go belly up, unfortunately. Not every deal is going to be your Uber, it's going to be your Facebook, it's going to be your Google. So like Abe mentioned earlier with ESG, right? It's not just about corporate responsibility, but I feel like as individual investors, if you want to promote a cause, right? Whether that be, something for the arts, or you really want to support your family member in this, then do that, because I think that it's not just the capital that'll go a long way, it's also your emotional support. And you'll feel like, look, you've put your time and your money into something that's worthwhile and will hopefully get somewhere.
Can I say one more thing? I think it's really important to know that how much money to put into this, right? This is supposed to be your play money, if you have it. But you should never put more than 10% of your investable assets in venture capital or early stage deals. If this is money that you should, when I give money to my family, I never expect it back. And it should be the kind of the same with VC. Don't think this is going to be your retirement money, just so you know. Okay.
My piece of advice would be find somebody who does this well and shadow them. Start asking them questions. Join a network, join the angel network, join a venture network that has, community of non-accredited investors that will help educate you. Find people who do this and learn from them. Ask if you can invest a small amount under them, as long as you trust them, obviously. But do something like that where you can open yourself up to that environment at low risk because you know that this person has had a success rate before. So that would be my advice.
Yeah, so from an investing standpoint, I'll say everything they said, right? I don't think there's a whole lot more to add. I'll take a different, give you a different take on it. Depending on where you are, if you qualify to be an accredited investor or not. If you're not, you heard about some options. But I'd say think about it this way, right? In this day and age, the world is kind of flat, right? So if you have expertise, that expertise is valuable. And that expertise is probably valuable to maybe a startup if you're not starting a company yourself. And there's a lot of things you can do with that in terms of learning how to leverage your expertise and invest that, and instead of possibly investing capital, right? So you have expertise that can create content. You have expertise that can lend to being an advisor in a way that's valuable, something you're passionate about. So the alternative thought is think about you as the investment and how you might be able to be valuable to a team and to a group. And then one more thought I'd just say is, one of the things that some of us often talk about when we're on panels or we're talking to each other, offline, is that there's a lot of startup hyperbole around just go out there and do it and rah-rah and persevere and you really got to be so when you think about investing, you're investing your time and your effort, and there's a process, and you're either going to spend money through that process, or you're going to take your time and do it right. And the process is that I think on this end, I don't remember who said it, but you have to be focused on a problem. You have to understand that problem. You have to understand the buyer, and there's gates you need to go through. And you're not supposed to go through to the next stage until you finish the stage before it. And often what happens with, it's just as everyone is saying, investing is just really, really risky. And for the entrepreneur, it's even more risky when it's your capital, your family's capital, your time, and you just are excited about doing it and you're not listening about how to get through the stages. So whether you're investing, your money or you're investing your time, you just got to really be smart, and you can't manipulate the process. It is what it is, and it's either going to bring that company down and your money. So when you're thinking about investing, make sure you're paying attention to who's running that company, and are they listening? Are they realizing how difficult this is and going through the right process? Because that also might be an indicator as to if you should put your money or your time into it.
As far as the education piece, I think that I echo what everyone else here has said. I will say that spending most of my career developing and marketing alternative investment products to accredited investors, like democratization of capital, something that I've really come to be very passionate about, and democratization of capital and investable opportunities. I will say that if you go to our website, we do have an impact investing guide for the rest of us, which is basically a digest of the impact investing platforms that not accredited investors can do. We don't opine on whether they're a good one or not. That's not really our place, but we try to create a convenient home or a hub for people to go and to look. It's an open source project, so just it doesn't look that pretty, but it's the basis is there. And if you want to help contribute to that research, I'd love to talk to you as a volunteer. So.
What's the website?
Oh, sorry. Thank you. It's thesiia.org.
Okay. Do we have any questions from the audience?
Can you repeat that website?
Yeah, sure. It's thesiia.org.
Go
I do a lot of mentoring, and a lot of the essence here is the balance between the idea and the person. Do you invest in the idea, or do you invest in the team? Because ideas can be pivoted, ideas can come and go, but the team. So, other than going to an undergraduate degree in entrepreneurship, how does a budding entrepreneur best prepare themselves for that investment pitch, recognizing their potential? The non-traditional way of recognizing potential in an ex-prisoner, for example, you mentioned there. We talk a lot at Station and other about preparing your pitch, preparing your value proposition, preparing your competitive advantage, your target market. We don't talk a lot about how to recognize the potential in yourself as a future entrepreneur, even if you haven't had the privilege of doing a bachelor degree in business or whatever, entrepreneurship. So is there an opportunity there for something to help people recognize their own potential as a future entrepreneur? And just a sort of general question about, should we be doing more to help people recognize their own potential?
I wish you'd been here for the previous panel. We had 6 different organizations talking about how they can help you, including HCC, U of H SURE program, we had entrepreneurship firm, HCC, Hall's Small Business University, Baker Ripley, they do the Kaufman Fast Track program. There's so many organizations that are helping entrepreneurs at the early stage, trying to help them get to, from 0 to 0.5, 0.5 to 1, and then funnel them into the investment community. Yeah, go ahead.
So I'm sure there's a lot of answers on this and opinions, but the thing that, piggybacking I guess on my previous comment, a lot of times you see folks who want to build a product and go out and sell it, and I think Stephanie was saying earlier, understanding some of the fundamentals I think is key, and in terms of them kind of understanding their own potential, there's this domain expertise element. Right now I would say if you look across the panel, I would say most of us would tell you that the things that end up getting funded, especially when you think about early stage tech deals, the investor is looking at folks who know how to develop a product. So they end up having some level of understanding and expertise in product management, product development, or they end up being an engineer. So if you're doing a startup and you don't have those components and you don't have a co-founder with those components, it starts to be really difficult. So my answer would be kind of aligning your expertise with the opportunity. And if you're not in one of those core areas, then you need a team around you to kind of fill that in, or you need to go get a position, a job with one of these startups, and what I call kind of see the movie, right? Too many people haven't seen the movie and understanding how these things flow and go, and they go out and try and start a business, and when you see the movie, you either start to get it really fast and that potential, but I would encourage a lot more people to go work at a startup, go work at a high-flying company, understand what's happening, pay attention, look at it, the same way someone would have told you 30 years ago, go start in a mailroom, right? It's like go work at a startup and watch it, watch the process and watch everything that's happened. And I'm sure every one of us up here would tell you there's a story, and it's, you didn't start out just getting there, So that's what I would say, and then there's not enough of the EQ, so the emotional intelligence elements, I think in the startup world as well. I think there's some of that there, but probably a different conversation.
Did you want to say something?
Oh, I thought so.
I would just reiterate the team, and also the support system, both professionally as well as within your personal life, to make sure that you're prepared. And I look at my own family and realize that if I didn't have the exact support structure I have right now, my life would be a total disaster at the moment. it's already hard enough just trying to start something, but you have other people in your lives and other things you care about, and the ecosystem that you've built around yourself, either through on a personal level, from a professional level, the team that you've got around you. I'm a big believer in having co-founders and people that balance you out and have areas of expertise that complement you, because there's a million things you don't know and a million things you got to figure out, and to have that balance to say that, okay, well, I've got this covered, you go do that, and I trust that, you know, we're going to create something better together. I think that means a lot.
Hi, my name is Alina. I'm a serial inventor of products that solve problems for women. Received my first patent, got it, and launched it to the market. Recently got another patent, and looking for investors that will contribute to the launch. My question is, how do you value a company at such a beginning stage of a company, with a patent, the idea, and the know-how of how to bring the product to market?
Yeah. Look, you're looking at me, so.
I'll give you the mic.
It's really tough without revenues, right, to value a product. And we get asked this question quite a lot. Mostly it feels like you're sticking your finger on there. But it's usually on comps, right? So what are products in your market currently raising at what valuation at your stage, right? Whether it's MVP or product, prototype, or do you have initial customers? So look at the cohort around you and what they're raising at. But it's really important. This question of valuation is really important. It tends to be the sticking point between most founders and investors. You have to realize that taking money from investors is the most expensive form of capital, because you are giving up control and equity in your business, right? And so if you can find ways to bootstrap and get Tim Jeffcoat was here from the SBA. I always want to say SIPC. The SBA, and repay it. It's much cheaper. But really, it's going to be what the market will bear. You might have an idea of what your company is worth, but if investors aren't willing to pay for it, and you're not willing to come down, it could take you a long time to raise money, and you're wasting a lot of time raising money just because you're stubborn. So you have two options. You can go slow and do it yourself, or you can go, it depends on how fast you need to go, right? If you've got patents, you might have a little more time, more protectability of your product. But if not, if it's a market play, you need money, you need to go fast, and it's better to have a small piece of something big than nothing at all. So that's a whole lot to say. It's really hard to come up with valuations, and it should be a conversation between you and an investor. They should add more than just money and look at comps.
So we encourage, founders to hold off as long as possible, right? Because the more value that you can demonstrate, the less equity you have to give away when we do make that investment. And so, because the higher your pre-money valuation is, the less money, the less ownership you're giving away for the check that the investor is writing. So if there's any way to demonstrate as much value as you can prior to going out and making that first ask, I would recommend that you do it, whether it's through loans, through crowdfunding, through whatever it might be. And the other thing is, investors, the ones who invest in your first round are also thinking about your success in the next round, right? We're not just in it for this one round. We want to keep following on, right? And so we have to understand, are the milestones that you're looking to achieve with the, say, $2 million you're looking to raise right now, can you actually achieve those milestones by the time your $2 million runs out? Because by that point, we're gonna want your company to be worth more. You should have demonstrated more value in your company and your product in that time that you spent that $2 million, because that means an uptick in valuation. And then when you go out and raise the next round, you as the founder and your current investors don't get diluted by more investors, right? And so we always want to set you up for success when we're raising a round, and we don't set pre-money valuations lightly, right? But we also have to understand, can you truly hit the milestones that you promise you're going to hit with the amount of money you're raising? So we calculate backwards from that, right? If you can hit that goal and you say your company's worth 10 million with no revenue, no product, but you can truly hit it and we can believe in that vision, fine. But otherwise, you know, you're going to have to, you don't want to be at that stage. Spent $2 million, your company's still not worth anything, you have to go out and raise more money, you're just going to get diluted.
I promised Heath that he would be able to go to his daughter's birthday, so. Answer this question.
Oh, I was just gonna say, one thing to keep in mind is that a lot of entrepreneurs pitch investors. The best deals, the investors pitching the entrepreneur. So that's really the answer to your question, right? Is that when the investor's chasing you, you got a hot deal. Otherwise, you're at the whim of the investor, right?
Taking time.
Yeah, as to what terms Lily and Stephanie are gonna offer, because they're crunching the numbers and it's like, right? But when you got a hot deal, they're willing to bend. So you gotta make your, well, it's what Lily was just describing, right? It's one where all the pieces are in place. You understand the market, you understand the problem, you've got buyers lined up, you've got revenue, or in your case, you've got LOIs, you've got commitments. If you build it, they're gonna buy it. You know, you've got things that make them feel like it's de-risked, and just as Lily just said, you can hit the number, and you've got proof you can hit the number. If it's hope and pray, she's out.
And something that you had mentioned earlier, right, when it comes to the mentoring the team or mentoring the product, for us, it's generally going to be the product, right? Because we look at it as the market is the race, the horse race that you're in. Are you in some local track where you're really just running 10 times, or are you in the Kentucky Derby, right? How big is that market? And then we're looking at your horse. Are you riding a miniature Shetland pony, or are you riding a thoroughbred? Right? And then we're going to look at the jockey. Are you an experienced jockey, or are you a first-time jockey, but you can hang on for the ride? Right? And so for us, we rather back the thoroughbred, even with an inexperienced jockey who can hang on for the ride, because that horse will cross the finish line.
Good metaphor.
It's a great one.
Any other questions?
Drop the
Yeah, I just want to know, and I know obviously this is really important to any investor, the whole point of scalability, but I'm just curious to hear from you guys, because I'm a big Shark Tank fan and you hear that a lot, how we're going to scale this thing. Is that the main thing you look at? I mean, if you have a founder with a hot deal and it looks like, you can scale fast, or do you pick someone with a business you still really like, or maybe you really like the founder, and you think it may take a little longer, but I still really like this deal? I mean, how do you kind of balance that?
I can answer that. So we always are looking for scale, but the right type of scale is really important. So what you'll see in Silicon Valley is deals with no revenue. Someone's got an idea, and they're going to get customers that aren't paying. They're going to get big users, right? But it's just all about scale fast, grow fast, break things, right? Move fast. In Houston, and I think here, and I think especially with women founders, we're looking for sustainable growth. Is this growth going to be sustainable? And are you creating the right business that's going to be sustainable long term? You've seen these companies that grow really fast and their culture is broken. No one wants to work there. And they IPO and everyone's like, what is this business, right? It's not good. What we're looking for is sustainable growth towards profitability, right? So with one of our second investment is a company that's Uber for kids pretty much. But the woman was $7 million in revenue last year, 30 this year. She's on her way to 70 next year. But she'll be profitable next year, right? It's not just growth for growth's sake, but growth towards profitability and return, and sustainable long-term growth of the business as a solid business. That's really important.
And I think scalability means different things for different types of companies, right? I mean, for the VC investors that you see up here, we invest in high growth startups, like truly the ones that we invest in, and why you see so many of the startups on the news nowadays where it's just billion-dollar valuations with no profit. It's just that it's all about the users for them, and it's about how widespread, what's in demand, right? But sometimes scalability can mean if you're running, I don't like this term, but I can't think of another word for it right now, but a lifestyle business, right? Like if you're running like this business just for you, it'll sustain your family and you and your career, and you're doing great at it. Scale for you may mean something different, right? And for that, you don't need venture capital. And oftentimes when people talk about scalability, they're like, okay, I have to scale so I can get venture capital, right? Or I have to get venture capital so I can scale. And so it's understanding what you and your business needs and understanding what you truly want for your business, right? Is it venture? Do you want to make the next billion-dollar company because you want to grow a marketing team and a sales team and an engineering team and, build all these software products or build all these consumer tech products, whatever that might be? Or do you want to open like the next really cool Houston local coffee shop, whatever that might be? You could be a $3, $4, $5 million business on the hottest, strip in town. But but your scalability is different, right, than what that tech startup is.
There are investors for that too, but they just want a debt structure and they want royalties. So as you make more money, they take a piece of it. You just have to be careful. If you ever want to raise equity, don't start with that because the incentives are misaligned. Because it's keep making revenues because it's a cash cow. Versus equity, it's like grow, sell. So there's an exit.
I was going to say that exact point. It's why are you starting this business in the first place? Are you starting this business because you want to give it to a family member in 10 years? Are you starting this business just because you want to run it and you've got kind of no end goal with this? You may give it to family, you may try and sell it, you don't really know. Or are you starting this to grow it, to sell it in 3 to 5 years for, 3 to 10 to more times multiple, whatever you can get? And that's what you should be thinking about when you're starting a business. Why am I doing this? Fundamentally, am I doing this because it is a lifestyle choice? Or am I doing this because I want to play in this game with VC or with angels? Or, and you have to be clear on that up front when you're starting your business. What is this business going to be in 10 years? And who is it going to be for? Is it going to be for me? Or is it going to be something that I'm selling to somebody else?
I think one thing that I find helpful is there's an obsession about the unicorn, but there's this other concept called zebra, right? And it's just a different type of business. Not every business is going to be geared towards high growth. So I think that's just to me. I like that kind of schematic because it's we fantasize about the unicorn, but most businesses are probably going to be more like zebras.
Well, thank you all for your great advice and for being here for this panel. Thank you all for joining us. Please, a warm thank you.